Nothing changed about Costa Rica this year. No new law, no rent increase. And an American retiree living there is 11% poorer than in January. So here are 5 popular retirement countries that got materially more expensive in 2026, exactly what rose in each one, and whether a cheaper version of that country still exists. And I am going to keep 2 things separate throughout, because almost nobody does: the cost of living going up, which hits everyone, and the price of admission going up, which hits only you. Number 1. Mexico. And this is the largest single change on the list, by a wide margin. What rose? The visa. Effective January 1, 2026, Mexico substantially increased the financial thresholds for temporary residency. Reporting on the new consular requirements puts the monthly income test at approximately $4,400, up from roughly $2,800 the previous year. That is an increase of around 57% in a single step. The savings alternative rose in proportion, into the 70s of thousands of dollars. Residency processing fees also roughly doubled on the same date. Let me give you the comparison that shows the scale. The maximum Social Security benefit at full retirement age in 2026 is $4,152 a month. Mexico's reported income threshold is above that number. So an American whose retirement income is Social Security cannot meet it, regardless of how much they earned during their career. Where it is felt, everywhere, because this is a national immigration rule rather than a local price. It does not matter whether you are looking at Mérida, Oaxaca, Guanajuato, or Ensenada. The door is the same width in all of them. On top of the visa, rents in the most popular expatriate cities have risen substantially over recent years, driven heavily by domestic Mexican demand from Mexico City as much as by foreign arrivals. Mérida's historic center and the desirable parts of Oaxaca, San Miguel de Allende and Puerto Vallarta have all moved well beyond what they cost 5 years ago. Is there still a cheaper Mexico? On living costs, absolutely. Secondary cities across the country remain genuinely affordable and Mexican healthcare remains excellent value. But cheaper living does not solve a residency threshold. That is the point. Mexico did not get too expensive to live in. It got too expensive to be admitted to. Who does it still make sense for? People who qualify on savings rather than income, people with family ties to Mexico, people with income well above the average, and people who already hold residency and are renewing under the terms they already have. If that is you, Mexico remains one of the best value retirement destinations on earth. If it is not, you need a different country. Before the rest, 2 things you need straight. And I want to draw one distinction up front, because it explains most of what follows. There are 2 completely separate ways a country gets more expensive for you. The first is ordinary inflation and rent increases, which affect everyone living there, locals included. The second is specific to foreigners, visa thresholds rising, tax regimes closing, insurance requirements being added, or the currency strengthening against the dollar. That second category can make a country dramatically more expensive for you while the actual cost of living there barely moves for a local. Most of the biggest changes in 2026 are in that second category, and that is precisely why they caught people off guard. Number 2. Greece. What rose? The visa, and it happened before most people noticed. Greece's financially independent person route, the standard path for a retiree, had its minimum income requirement raised from €2,000 per month to €3,500 per month under Law 5038 of 2023. That is a 75% increase, and it has remained at that level through 2026. At the August 2026 exchange rate, with the euro at about $1.16, 3,500 euros is roughly $4,050 a month. Here is what makes Greece the sharpest example of the pattern I described at the start. Greece is still, on the ground, one of the most affordable countries in Western Europe. Rents outside Athens and the famous islands are low. Food is inexpensive. Thessaloniki and mainland cities like Kalamata, Patras and Ioannina remain genuinely cheap by European standards. So the cost of living did not really move. The price of admission did, and it nearly doubled. Where it is felt, at the consulate, not at the supermarket. Also, separately, Greek electricity costs have been a real burden and Greek summers have become hotter, which has turned air conditioning from a comfort into a necessity in much of the country. That is a genuine increase in the practical cost of living there, and it lands hardest in the months you least want it to. Is there still a cheaper Greece? Yes, for living. No, for entering. Unless you can document 3,500 euros a month or 84,000 euros in savings, the affordability of Kalamata is academic. Who does it still make sense for? Retirees with pensions and investment income comfortably above the threshold, and couples where the combined figure clears with the smaller dependent supplement. For them, Greece is superb value, because you get low living costs behind a high gate. Number 3. Costa Rica. And this one is different from the first two, because nothing about the rules changed at all. What rose? The currency. And this is the mechanism that people understand least, so let me be concrete. The Costa Rican colón has strengthened substantially against the US dollar. On January 2 of 2026 the weighted average rate was about 497 colones to the dollar. By April 10 it had fallen to about 462. By mid-August the rate reached around 448. Work through what that means for you. If your rent is 400,000 colones a month, at 497 to the dollar it costs you about $805. At 448, the identical apartment, with no increase in the local price whatsoever, costs you about $893. That is roughly 11% more expensive, in 8 months, for exactly the same thing. Now apply that across your entire budget. Your rent, your groceries, your electricity, your CAJA contribution, your bus fare. Everything denominated in colones costs you more dollars than it did in January, and your Social Security cost of living adjustment was 2.8% for the whole year. For a Costa Rican, nothing happened. For you, your income fell. Where it is felt, everywhere in the country, but hardest for people on fixed dollar incomes, which is exactly the retiree demographic. It is felt worst in the coastal and Guanacaste areas that were already the most expensive, and in the Central Valley towns that had been the affordable alternative. Is there still a cheaper Costa Rica? Relatively, yes. The Central Valley towns like Grecia, Atenas, and San Ramon remain far cheaper than the beaches, and inland areas away from the tourism corridor cheaper still. But the whole country has become more expensive in dollar terms and no location inside it escapes the exchange rate. Who does it still make sense for? People who value the climate, the nature, the political stability and the CAJA health system enough to pay the premium, and who have income with some margin rather than a budget calculated to the dollar. Costa Rica has not stopped being wonderful. It has stopped being cheap, and the honest framing is that you are now paying for quality rather than getting a bargain. The broader lesson from Costa Rica applies far beyond it. In any country that does not use the dollar, your real income is set by a number you do not control and cannot predict. That is an argument for the dollarized economies, Panama and Ecuador, for anyone whose budget has no slack in it. Number 4. Portugal. Portugal is the most complicated case here, because several things moved at once and in different directions. What rose, first, housing, dramatically. Lisbon and Porto have seen sustained and substantial rent increases over recent years, driven by a combination of tourism, short-term rental conversion, foreign arrivals, and a domestic housing shortage. The Portugal that was famous a decade ago for cheap apartments in beautiful cities does not describe Lisbon or Porto in 2026. This has been contentious inside Portugal, and it is worth understanding that Portuguese residents have been priced out of their own capital, which is why the political mood around foreign buyers has shifted. What rose, second, the tax treatment. Portugal's non-habitual resident regime, which for years offered substantial tax advantages to new arrivals and was central to the country's appeal, has been closed to new applicants. It was replaced by a much narrower incentive aimed at specific high-value professional activities that most retirees will not qualify for. So a retiree arriving in 2026 faces ordinary Portuguese taxation on worldwide income, which is a materially different proposition from what someone who arrived in 2020 faced. If you are reading older articles or watching older videos, this is the single most important thing they get wrong. What rose, third, though modestly, the D7 income threshold, which is indexed to the Portuguese minimum wage and sits at about €920 a month for 2026. That remains one of the lowest bars in Western Europe, so this is a small increase rather than a barrier. Where it is felt, overwhelmingly in Lisbon, Porto, and the Algarve. Also increasingly in the coastal towns near them. Is there still a cheaper Portugal? Genuinely yes, and this is the important part. Interior Portugal, meaning Castelo Branco, Guarda, Covilhã, Viseu and the Alentejo towns, remains affordable by any European standard. These are real cities and towns with hospitals, rail connections and universities, not hamlets. The interior is where the Portugal of the brochures still exists at the price of the brochures. Who does it still make sense for? Almost everyone, honestly, provided you adjust your geography and your tax expectations. Portugal remains the most accessible European Union residency route for a retiree. You just cannot have Lisbon on a modest budget anymore, and you should model your taxes properly before you go. Number 5. Thailand. What rose, the requirements, more than the prices? Health insurance is now mandatory for the retirement visa category, with minimum coverage levels for both outpatient and inpatient care. That is a new fixed annual cost that did not previously exist for everyone, and its size depends heavily on your age and medical history. For an applicant in their late 60s or 70s, this is not a trivial line item, and pre-existing conditions are commonly excluded, which means you may pay a substantial premium for a policy that does not cover the thing most likely to happen to you. The financial test itself, 800,000 baht in a Thai bank or 65,000 baht monthly income, has also become more expensive in dollar terms when the baht is strong, which is the same currency mechanism we saw in Costa Rica. And there is a compliance cost that is not money but is real: annual renewal, 90-day reporting, and maintaining the bank balance for specified periods before and after application. Enforcement of the seasoning rules on that deposit has become stricter. Where it is felt, Bangkok has become genuinely expensive in the central districts. Phuket and Koh Samui have tourist pricing that affects residents. Chiang Mai remains much better value. Is there still a cheaper Thailand? Yes. Chiang Mai, Chiang Rai, and the Northeast remain inexpensive, and Thai food and daily costs are still remarkably low. Just weigh Chiang Mai's burning season air quality, roughly February through April, as a health factor rather than an inconvenience. Who does it still make sense for? People who can pass the insurance underwriting comfortably, who have the deposit capital available, and who genuinely value the healthcare quality and food culture enough to accept being very far from the United States. Now let me give you the counterexample, because a video that only shows increases is telling you half the truth. Spain did not get more expensive to enter. Spain's non-lucrative visa threshold is tied to the IPREM index, and the IPREM has been frozen at €600 per month, so the requirement remains €2,400 a month, unchanged. Spanish rents have risen in the popular cities, certainly, but the admission price did not move. And several countries have kept low, stable thresholds throughout, Panama at $1,000, Costa Rica at $1,000 on paper, Portugal's D7, Albania's pension route. The dollarized countries, Panama and Ecuador, additionally protected their retirees from the currency effect that hit Costa Rica. So the pattern is not that everywhere got more expensive. The pattern is that the destinations which became most popular with Americans are the ones that raised their bars, and the ones that stayed obscure did not. That is not a conspiracy, it is just demand. Which raises the obvious question, how do you see the next one coming? Because the retirees hurt worst by these changes were not careless. They read the requirements, they qualified, they moved, and then the ground shifted underneath a plan that was correct when they made it. So here are the warning signs that a destination is about to get more expensive for foreigners, and they are surprisingly readable in advance. First signal, a domestic housing affordability debate. When locals start protesting about being priced out of their own capital, policy follows. It shows up as restrictions on short-term rentals, taxes on foreign buyers, the closing of investment residency programs, and sometimes higher income thresholds. Portugal and Spain have both had exactly this conversation. Watch the politics, not just the prices. Second signal, a residency program that has become genuinely popular. Governments notice when application volumes spike. A program designed to attract a few thousand well-off retirees behaves differently when it attracts 100,000, and the standard response is to raise the bar rather than to close the door. Mexico's threshold jump and Greece's near doubling both followed sustained growth in applications. Third signal, a threshold pegged to a local index rather than a fixed number. Portugal's D7 moves with the minimum wage. Ecuador's moves with the basic salary. Colombia's moves with the minimum wage. Spain's moves with the IPREM. These will rise over time, mechanically, and if you are qualifying with a thin margin you will eventually fail a renewal. Give yourself real headroom above the threshold rather than just clearing it. Fourth signal, a currency that has been unusually weak for a long time. A cheap country is often cheap partly because its currency is depressed, and currencies mean revert. Costa Rica is this year's example, but Colombia, Thailand and Mexico have all had multi-year swings that moved retiree budgets by 20% or more in both directions. If a destination is only affordable at the current exchange rate, it is not affordable. Fifth signal, new mandatory insurance or deposit requirements. These tend to arrive quietly, attached to a visa renewal rather than announced as a change, and they hit existing residents as well as new applicants. Thailand's insurance mandate is the clearest recent case. So what do you actually do with that? Qualify with margin, not exactly. If a threshold is $1,000, being at $1,050 is not a plan. Aim to clear it by a comfortable multiple so that an index adjustment or a currency move does not disqualify you at renewal. Rent before you buy, for at least the first year and preferably longer. Buying property converts a flexible situation into an immovable one, in a market you do not yet understand, in a currency you do not control, with transaction costs that are frequently much higher than in the United States. Almost every one of the changes in this video would have been survivable for a renter and painful for an owner. And keep your reserve in dollars. If the exchange rate moves against you, a dollar reserve moves with you rather than against you. That is precisely the moment you need it. 3 practical takeaways, and these matter more than the specific countries. First, check the date on everything you read. A great deal of retirement abroad content online was written between 2019 and 2023 and has not been updated. Mexico's threshold, Greece's threshold, and Portugal's tax regime have all changed since then, and the old numbers are still circulating widely. If an article does not say when it was written, do not trust its figures. Second, separate the 2 kinds of increase. Ask specifically, did the cost of living rise, or did the price of admission rise? They have completely different implications. Rising living costs can be solved by moving to a cheaper city inside the same country. A rising visa threshold cannot be solved by anything except more income. Third, and most important, if your budget is tight, weight currency stability heavily. Costa Rica is the lesson of this video. Nothing about Costa Rica changed. The rules held, the rents held, the country stayed exactly as good as it was. And a dollar retiree there is meaningfully poorer this August than they were in January, purely because of an exchange rate that no one predicted and no one controls. Panama and Ecuador, using the dollar, simply do not have that risk. If this was useful, subscribing genuinely helps. Now tell me in the comments, has a rule change or an exchange rate moved a country off your list in the last couple of years? Which one, and what did you switch to? That information is genuinely valuable to everyone else reading, because these changes travel slowly and a lot of people are still planning around numbers that expired. Educational information only. Not financial, tax, legal or immigration advice. Exchange rates move daily and immigration rules change without much notice. Verify every figure with the official government source before you act on it. But a rising country is only half the danger. The costs that quietly ruin a cheap retirement are the ones nobody prices at all. Watch our hidden costs investigation next. It is on your screen now.